Welcome to the debate. It is Monday, February 2nd, 2026. If you haven't checked the terminal this morning, you might want to sit down. Gold isn't just flirting with the $4,000 line anymore. It has smashed right through it. We are looking at a market that is, fundamentally repricing the concept of safety in real time. Goldman Sachs is already pointing toward $5,000, but frankly, the fixation on the price tag, it kind of misses the point. The price is just the symptom. The real story isn't the ticker tape, it's the buyer.
It is a historic chart, I'll grant you that. I was looking at the volatility index this morning, and it's telling a story of its own. But we have to be careful not to confuse a price spike with a complete paradigm shift. We're seeing a very loud signal, yes, but I'm not convinced it means the global financial machine is broken beyond repair.
And that is the central question we're tackling today. Is this historic surge in central bank gold accumulation, specifically the accelerated buying we saw closing out 2025, is it just a temporary panic room reaction to high interest rates and war? Or are we witnessing the permanent structural end of the US dollar's hegemony in global reserves? I'm taking the position that the system has, in effect, broken. This is a global rebalancing. Gold is replacing the US Treasury bond as the ultimate store of value because the trust, that invisible glue that held the dollar system together, has dissolved.
And I'm here to tell you to look closer at the ledger. While the buying is heavy, the data shows it is incredibly concentrated. This isn't a global revolution. It's a strategic hedge by a handful of specific actors. The usual suspects like China, plus some exposed players like Poland. In fact, if you dig into the data, year-to-date buying has actually slowed compared to the frenzy of the last few years. And why? Well, because gold is expensive. This is insurance policy buying, not some burn the ships moment for the global financial system.
I want to challenge that insurance label right out of the gate because the data from late 2025 suggests something much more aggressive than just hedging. We have crossed a Rubicon. For the first time since 1996, global central banks hold more gold in reserves by value than they do US Treasuries. Let that sink in. For 3 decades, the US Treasury bond was the bedrock, the pristine collateral of the world. Now the barbarous relic is worth more than the debt of the world's superpower. That is a psychological shift that you cannot undo.
But let's be precise about why that crossover happened. It's important not to, mislead on the mechanics here.
It happened because they are voting with their vaults. It's not just passive appreciation. According to the latest report from EBC Financial Group, central banks didn't just buy gold. They actively dumped $48 billion in US Treasuries in the first half of 2025. That is a rotation. They are selling the dollar to buy the metal. It's a rejection of counterparty risk. When you hold a treasury, you are trusting the US government to pay you back and not to sanction you. When you hold gold, you trust no one. And right now, trust is in short supply.
You're weaving a compelling narrative, I get it. But you're kind of cherry-picking the value statistic to support the dumping thesis. Yes, gold reserves are now worth more than Treasury holdings. But a massive percentage of that flip is simply because gold re-rated to $40,000 an ounce. It's a valuation effect, not just a volume effect. If I own a house and its price triples, I didn't necessarily buy 3 more houses. My net worth just shifted composition. The $48 billion sell-off you mentioned is significant. I won't deny that, but in a market of trillions, it's not a stampede.
But the volume is there. We aren't talking about a couple of tons here. Look at the sheer tonnage. Central bank demand exceeded 1,000 tons annually for 2022, 2023, and 2024. That is unprecedented consistency. We haven't seen sustained buying like that since the collapse of Bretton Woods. And while you might point to 2025 showing some variance, the intent is undeniable. We are seeing a doctrinal shift from yield at any cost to resilience at all costs. The World Gold Council has even flagged significant unreported buying. That is the smoking gun for me. This isn't just portfolio management. This is nations quietly exiting the dollar system, via over-the-counter markets specifically to avoid detection.
I'm glad you brought up the volume data, because that is exactly where my skepticism comes from. You mentioned the 1,000-ton years, and they were impressive. But look at the World Gold Council data from October 2025. Year-to-date buying was 254 tons. That is a significant deceleration compared to the pace of the previous 3 years. you have to ask yourself why the brakes were pumped.
Because the physical supply is tight. You can't buy what isn't there.
No, because the price is $4,000. Even sovereign nations have budgets. Price sensitivity exists for central bankers too. When an asset triples in price, you naturally buy less of it to maintain your target allocation. Moreover, look who is buying. It's Poland, China, Turkey, Brazil. Where is the Bank of England? Where is the ECB? The Federal Reserve? The major Western architects of the financial system are largely inactive. They are holding what they have, sure, but they aren't rushing for the exits. This tells me the flight to safety is a localized phenomenon for nations with specific geopolitical vulnerabilities, like Poland sharing a border with a war zone, rather than a global repudiation of the U.S. financial system.
You're dismissing the 1996 crossover as a valuation trick, but I think you're underestimating the psychological impact of that metric on the broader market. Financial markets run on narratives as much as math, and the fact that the world's savings are now weighted more heavily in metal than in American debt, that's a signal that the risk-free asset isn't the Treasury anymore. It changes the conversation in every boardroom. It's a signal of price inflation in commodities, largely. It is a signal of weaponization. We have to look at the catalyst. The EBC Financial Group analysis points out that foreign holdings of treasuries are at their lowest since 2017. Why? This acceleration correlates perfectly with the Liberation Day tariff incident in April 2025. The world watched the U.S. executive branch leverage the dollar and the Treasury market as a blunt political tool. It brings to mind the old fears around the Gold Reserve Act of 1934, the fear that the executive has too much power over the currency. I mean, if I'm a central banker in Brasilia or Riyadh, and I see the U.S. using the dollar to punish policy disagreements, gold becomes the only politically neutral asset left.
I don't disagree that sanctions have consequences. Weaponization is a real concern for anyone on the receiving end of U.S. foreign policy. But we need to separate political signaling from operational reality. You talk about replacing the Treasury, but de-dollarization is incredibly difficult mechanically. China's the poster child for this, right? They've been trying to reduce Treasury holdings since 2011. They went from roughly $1.3 trillion to $765 billion. That is a slow, grinding 15-year process. It's not an overnight dump.
But the direction of travel is all that matters. They are unwinding the position.
Speed matters too. The dollar offers liquidity that gold simply cannot match. In a crisis, you cannot easily pay for imports with gold bars. You need liquid currency to settle trade. Treasuries are the collateral of the global banking system. You can pledge them, repo them, move them in milliseconds. Gold is it's a pet rock that sits in a vault until you sell it for $4.
Liquidity is a trap if the asset can be frozen. You say gold is a pet rock, I say it's the only asset that requires no permission to use. Look at Turkey. They have been net purchasers for 26 consecutive months as of late 2025. Why? They are a NATO member, but they understand that in a world where SWIFT can be weaponized, where your digital balances can be zeroed out by a vote in Washington, gold is the ultimate liquidity because it has no counterparty. You don't need a correspondent bank in New York to own it.
But it also has no yield. And this is the economic gravity you can't ignore. We spent a good portion of 2025 in a high interest rate environment. Holding a non-yielding asset like gold when you could be earning 5% or 6% on short-term paper is a massive cost for a central bank. That opportunity cost bleeds your balance sheet. I think that explains a slowdown in accumulation speed I mentioned earlier. It is expensive to hold gold, storage fees, insurance, and the 5% yield you aren't getting.
That logic held up in 2010. It doesn't hold up in 2026. The definition of cost has changed. The cost is no longer lost yield. The cost is the potential total loss of principal through seizure. Central banks are realizing that return of money is more important than return on money. When you fear the principal is at risk, yield is irrelevant.
Fair, but let's look at the buyers again. You implied this is a global revolt. I keep pointing out it's the usual suspects. If this were a true structural shift, wouldn't we see the allies moving? Wouldn't we see Canada or Australia?
We are seeing the allies move. That is the biggest development of late 2025 that the mainstream press is glossing over. Look at the National Bank of Poland. This is a NATO member, a European Union member. In October 2025 alone, they bought 16 tons. And they didn't just buy, They announced they are increasing their target allocation to 30% of their total reserves. That is aggressive. That is not a hedge. A 30% allocation is a war chest.
Poland is a frontline state in a geopolitical conflict. They have a war on their doorstep. It is entirely unique.
It's not just Poland. The National Bank of Serbia is aiming for 100 tons by 2030. The Czech National Bank has been buying for 29 straight months. These are European nations. They aren't anti-Western rivals like China or Russia. They are integrated into the Western system, yet they are seeking safety outside the dollar. When your friends start buying insurance against your currency, you know the hegemony is cracking. They are reading the tea leaves, and they see that the US dollar is becoming a liability, not an asset.
I interpret the European buying differently. Poland and Czechia are buying insurance against the fallout of the Russia-Ukraine war, not insurance against the US dollar itself. They need assets that are physically within their borders in case of a continental crisis. It's about physical sovereignty, not monetary ideology. If this were a collapse of trust in the West, we would see the Swiss National Bank or the Bank of Japan adding tons. They aren't.
Yet, it always starts at the periphery and moves to the center.
And here is a data point that really complicates your sanctions-proof narrative. Russia. If gold is the ultimate weapon against the West, the ultimate shield for sanctioned nations, surely Russia is stacking every ounce they mine. They should be the biggest buyer on earth. But in October 2025, the Central Bank of Russia was the only bank to report a decline in reserves. They sold 3 tons.
Come on. We both know that transparency of these regimes is questionable at best.
Data is data. They reported a sale.
And the World Gold Council explicitly mentions unreported buying through over-the-counter markets. It is highly probable, I'd say almost certain, that the reported decrease in Russia is accounting noise or maybe liquidity management for domestic issues. Meanwhile, the true accumulation by the non-aligned bloc is happening in the shadows. The EVC report highlights that phantom demand. If you are trying to de-dollarize without tipping your hand and driving the price to $6,000 before you're done buying, you don't report it to the IMF every month. The official numbers are the floor, not the ceiling.
We can speculate on shadow buyers all day, but we have to ground ourselves in the visible flows. And the visible flows show a fragmented picture. Brazil bought 16 tons in October. India buying small amounts. Uzbekistan buying 9 tons. These are emerging markets. This is the global south, diversifying. That is rational. But a diversified portfolio is not a revolution. It's just prudent asset management.
I think you are underestimating the impact of this global south diversification on the price mechanism itself. These central banks are effectively creating a price floor under the market. This is crucial for understanding why gold is at $4,000 and why it's not coming down.
How so?
Because central banks are sticky buyers. They buy for strategic reasons, sovereignty, national survival, so they are far less price sensitive than a hedge fund or retail investor. When the price dips, they don't panic sell, they buy more to fill their vaults. This structural demand creates a permanent bid. JP Morgan is forecasting 900+ tons of annual demand through 2026. That is a sustained bid that puts a permanent premium on the metal. They are removing supply from the market, likely forever. Once that gold goes into the National Bank of Poland's vault, it isn't coming out next quarter.
That is a strong argument for the price, I admit. This sticky buyer thesis holds water. But have you considered the risk of the feedback loop reversing? You described a wealth effect earlier, but you have these central banks buying at the absolute top of the market. $4,000 gold is priced for perfection, or rather, priced for disaster. If geopolitical tensions ease and history suggests they eventually do, the fear premium in that price could collapse.
You think gold is going to crash back to $2,000?
It doesn't have to crash. It just has to correct 20%. Central banks, particularly in emerging markets, cannot afford to be left holding the bag on an asset that drops significantly. Fiscal reality eventually hits. You cannot print infinite money to buy $5,000 gold without causing domestic inflation consequences. If the war in Europe stabilizes, or if the US economy strengthens, the dollar rallies, and gold drops. Suddenly, that war chest in Poland is worth 30% less. That is a political risk for the central banker at home.
See, I think you're looking at the balance sheet risk the wrong way. The wealth effect of gold is actually a massive hidden buffer, even for the US. The US Treasury holds over 8,000 tons of gold. Do you know what it's valued at on the books?
The statutory rate, it's something archaic.
$42.22 per ounce. That is the official book value. It's almost comical. But at market rates $4,000, that reserve is now worth over $1 trillion. It is massive, unrecognized equity. But here is why the buyers don't care about the price drop risk you mentioned. For them, the price volatility of gold is secondary to the solvency risk of the U.S. government. They're hedging against a sovereign default, not a market correction.
Solvency risk? Now you're claiming the U.S. is going bankrupt. That's a bridge too far.
I'm saying the math doesn't work. This brings us to the real motivation. It isn't just war. It is debt. The U.S. is running deficits at 7% of GDP in a time of relative peace. We are seeing extraordinary debt levels, to quote the EBC report directly. The trust in the risk-free status of treasuries is evaporating because the fiscal dominance is undeniable. Central banks are front-running a potential U.S. sovereign debt crisis. They look at the U.S. political polarization, the threats to the Fed's independence, and the deficit, and they are opting out. They aren't buying gold to make a profit. They are buying it because they think the dollar is going to lose 20% of its purchasing power structurally.
I acknowledge the U.S. fiscal issues are grave. 7% deficits are unsustainable, and the debt service costs are eye-watering. But gold is a diversifier, not a replacement. Look at the allocations. Even Poland, your most aggressive example, is targeting 30%. That leaves 70% of their reserves in other assets, primarily fiat currencies and primarily dollars and euros.
But 30% is a return to pre-Bretton Woods levels. That is a massive shift from the 5% allocations we saw a decade ago.
It is still a minority position. The system isn't breaking, it is just becoming more expensive to insure. We are seeing a recalibration. The dollar remains the anchor of trade. You price oil in dollars, you price aviation fuel in dollars, you largely price gold in dollars. As long as that network effect exists, central banks will hold dollars. You cannot run a modern economy purely on gold bars in the basement. You need the velocity of the dollar.
For now. But the trend line is what scares me or excites me, depending on the day.
Let me summarize my position, because I think we need to keep perspective here. The buying is impressive. The price action is historic, but the volume is slowing down due to cost. This is a prudent move for emerging markets facing currency volatility and specific regional wars. It makes sense for Poland. It makes sense for Brazil. But the U.S. dollar remains the operating system of the global economy. We are seeing insurance buying, not the birth of a new gold standard. It's a hedge, and an expensive one at that.
I respect that caution, but I believe the signal is stronger than the noise. The trend is structural. The trust that underpinned the dollar system was broken by sanctions and fiscal irresponsibility. Whether it is Poland, China, or Brazil, the world is voting with its reserves for an asset that cannot be printed, cannot be seized, and has no counterparty risk. The shift to resilience at all costs means the role of gold is fundamentally changed from a commodity to a necessity.
I think we can both agree on one thing. The era of the US Treasury being the only risk-free asset is effectively over.
On that, we are in total agreement. The portfolio of the future looks very different from the portfolio of the past. Thank you for listening to The Debate.